So Mansa-X actually had a very good quarter, one of the best quarters we've had to begin the year with. So for the first quarter of 2023, the Kenya Shilling Fund returned 3.99%. That's almost 4% for the quarter. That's about 15.96 annualized return, net of fees. The dollar fund also did exceptionally well, returning 3.38% for the first quarter, which translates to about 13.52% when you annualize it. So this is a very good quarter. If you compare with the performance the previous quarter, so the last quarter of 2022, where the Kenya Shilling Fund returned 2.61% in that quarter, which is about 10.44% annualized. So essentially we can say the fund delivered about 5% better return in Q1 of this year compared to the end of last year, which is a very optimistic way to start the year. And even for the dollar fund, the fund delivered about 4% higher than it did closing the quarter of last year. So we feel that this is an optimistic start to the year, and we're very happy about that performance. In the first quarter of this year, we took advantage of a rebound in the stock prices. If you look at last year, most stock prices, actually most indices took a severe hit of over 25% across the board. So this year, we were really just capitalizing on a rebound of some of these stocks. In fact, it was very interesting to see that a lot of what were short positions for the fund last year, especially in tech stocks, we saw a severe reversal of some of these. In fact, the biggest gains we saw in the first quarter were for tech stocks, which were significantly short positions last year. So in this regard, we then took long positions in really most of the indices as a whole, not even just individual stocks, even if we still had that. But so the biggest positions we had, for example, we were long the DAX index, we were long NASDAQ, but individually we were also long some companies like the tractor supply company and Motorola. We were also long some currencies like the Swiss franc, which again turned out to be quite lucrative plays for us. On the positions that we were short on, meaning that positions where we expected to make money if the value of those assets lost value, it was really mostly banking stocks, because we were trying to take advantage of the banking crisis that we saw in the first quarter. Of course, the first one we saw was the Silicon Valley Bank, mostly created by the fact that yields in the US are approaching 4%, which of course then means that for a bank, it then becomes very difficult to exit these positions at a profit if you had bought them at much lower yields. You know, you must keep in mind that most banks bought a lot of their US treasuries at levels close to 0%. So for you to then have to sell at levels of 4% when you're stressed for liquidity, that can create pressure in a bank, and that can lead to the downfall of a bank. So we saw that happen with Silicon Valley Bank. And in continental Europe, we saw the same thing happening to Credit Suisse. So for SVB, we saw a collapse there, and then in continental Europe, we saw a buyout of Credit Suisse by UBS. But the advantage of our fund is that then we're able to take advantage of such situations. So one of the things we did was go short Prosperity Bank shares. That's a regional bank in Texas. It was a very lucrative play for us. In terms of other short positions that we were in, one of them was natural gas, where we expected the value of natural gas to fall due to normalization of supply of gas into Europe. And on top of that, just lower demand, because with winter coming to an end, then obviously natural gas prices were expected to fall. So we also took advantage of that. For the dollar fund, the only thing I would say was slightly different was we had some positions in African Eurobonds, which of course were quite lucrative for a fund not as big as the Kenya Shilling Fund. But also we had long positions in commodities like sugar. So those were the key positions. So really in summary is that Q1 was really a play on the reversal of most of the moves that were seen in 2022. And this offered the fund very lucrative opportunities to make a return for investors based on those reversals. So the best performing assets are actually the ones I've just mentioned. So I'll just give the percentage moves. For DAX, we saw a gain of 12%. That's significant for just one quarter. NASDAQ was up 20%. Again, for just a quarterly move, that's quite significant. The Swiss franc gained 1% against the dollar. For currencies, again, that's a real move. Then some of the companies like Motorola moved over 10% in gains. For short positions, Prosperity Bank shares fell by about 15%. Again, those are moves that can really be taken advantage of, especially when you're trading using the model that we have. Natural gases was a big one, losing over 50% of its value in one quarter. So those, I'd say, are really the biggest moves you saw. I guess also, if I was to speak a bit about yields, for US Treasuries, for example, we saw yields drop by 10%. Again, this is a really significant move for fixed income markets. So again, that was also very lucrative. On the Kenyan space, or rather in the Eurobond and African Eurobond space, there was also a lot of volatility. Okay, we have moves of up to 200, 300 basis points in a week. For a fund like ours, which trades these kind of positions in an active way, this was also really something that enabled us to capitalize on capital gains by buying and selling these papers in the international market. For the second quarter of this year, and in fact just moving forward, we still think that the reversals in the stock market that we saw in Q1, we expect that this will continue. We feel as if, one of the major factors of how we traded last year was really central bank actions. So we saw the Federal Reserve, increase interest rates at least recently to at least up to 5%. And then we also saw the same thing happening in the UK and in Europe, mostly because inflationary pressures have been so high that overtook any other concern. In fact, it's interesting to see how even during a banking crisis, like we saw with the collapse of Silicon Valley Bank, that did not create a pause with the Fed in terms of raising interest rates. But moving forward, we believe the rate at which, starting with the US, the rate at which the Fed increases interest rates is actually going to reduce. We actually expect this to lead up to a pause. So we expect that maybe until we reach levels of maybe 5.5% on the Fed rate, from that point we expect a pause in interest rates. So this has a few effects. The first one is this gives an incentive for stock market traders to continue ramping up positions, so we expect more gains in the stock market. The second thing is we have been witnessing very significant dollar strength across the board. We expect now this will wane and the dollar will actually start losing value. And to begin with, against the major currencies. And there's a reason for this. The first being, if you look at inflation rates in the UK and Europe, they're still very high. Just recently, we saw the UK inflation rate surpass 10%. So based on this, you have what you call an interest rate divergence. In the US, there's a pause of interest rate hikes, whereas in the UK and continental Europe, they continue to increase interest rates. This will weigh down on the dollar. The third thing are yields. So of course, with a slowdown in Fed rate hikes, or as we expect, eventually a pause, then we expect maybe now yields, especially for the longer dated bonds, to then start coming off a bit. So those are the three things that we expect for moving forward into the year. Locally, and I think this is something that a lot of our investors have been asking us, there are concerns, especially around two major things: the effect on the strength of the shilling, the strength of the dollar against the local currency, the Kenya shilling, and also all these talks about, is the Kenyan government going to default on debt, both local and international, meaning our Euro bonds. There was a lot of pressure on the shilling based on really just loss of demand in the economy for dollars. But also currencies have a tendency to create speculation and speculative activity, where the moment even any layman on the streets decides to start holding their savings in dollars on anticipation that it will gain value, this becomes a self-reinforcing narrative that then again works against the local currency. So recently, we saw the government make significant efforts. For example, our biggest import bill is actually oil. So we saw the government get into arrangements where we don't have to pay for oil immediately, and we then pay on 6 months intervals. That in itself reduces a lot of pressure on the shilling. So we think that that would be very useful in reducing the pressure on the shilling in the near term. On top of that, we saw the central bank release a code of ethics for intermediaries in the forex market. This includes banks and forex bureaus. So we saw, for example, what you call the spread between the buy and sell, significantly reduced by creating a framework in the interbank market that now makes it easier to trade the dollar against the shilling. This in itself has the effect of creating a truly functional market, which is not really a one-way market, but a market that can be based on demand and supply. So for this reason, we feel as if this in itself keeps the dollar against the shilling rate in check. So even if you have a depreciation, the depreciation is not as quick as what we witnessed, the first 2 months of this year. So those are some of the things that give us a bit of comfort. But moving into now our investors who are invested in Mansa-X, a big portion, as we've always said, of our investments are in foreign currency, and mostly actually dollars. So they actually have been benefiting from a loss in value of the shilling against the dollar. But again, that is not a strategy in itself. It's really just the situation of what the fund invests in. So for now, it happens to be a very lucrative position for those who are invested in our fund. So really nothing to worry about. On government debt, which again is a narrative that has recently come into public conversation, we feel in Mansa-X, we actually believe that there's very little chance that the government can default on local debt. Yes, there has been a lot of pressure on government debt maturities that the government has to pay off, obviously. But we also feel like if you look at this year, the maturities that we have after next month, which is the month of May, a lot of maturities fall within that month, and the maturities are actually mostly T-bill maturities. But after that, we don't have any major maturities until January next year. So based on that, we feel like the government has enough space to manage local debt, and we then don't worry about it. We've also seen some discipline where, for example, the central bank recently canceled an auction, sending a message to market participants that they will not pay beyond a certain level for debt exceeding a certain period. So yes, at the moment we have very expensive debt for short-term papers, T-bills and so on, but there's nothing wrong with that. Considering that our central bank rate now is at 9.5%, okay, it means that near-term money is expensive. But near-term money is expensive deliberately at the moment to manage inflationary pressures in the country. And we believe that once these inflationary pressures are off, then interest rates will normalize back to much lower levels. And again, this then even speaks for Eurobonds, because we have the 2024 Eurobonds, and there's been a lot of talk even in international media about Kenya defaulting on the 2024 papers, which mature next year in June. So essentially, with yields now trending towards 20%, for us, we feel that this is a mispricing. We don't believe that a paper that is 1 year to maturity should really be trading at those kind of levels. And even for investors who are invested in these papers, a 1 year period is very short. It will make more sense to just hold them to maturity rather than try to exit into the markets with disproportionate sentiment, and then you end up losing, some of your principal because you then sold at a market with a much higher yield. We feel that that period is short enough to hold those papers to maturity, and as we move towards normalization of interest rates globally, with the Federal Reserve reducing interest rates, we believe that a lot of pressure will come off from a lot of Eurobonds. So even now that speaks to longer papers like the Kenya Eurobond 2028s and 32s and so on. We feel that even those ones should even normalize faster because within that period, obviously, inflationary pressures for most countries around the world should have come off, and so therefore also the interest rate pressures. So there are obviously valid concerns around debt management from investors, but we feel that some of these fears have reached levels that now are a bit unwarranted and create a bit of mispricing in the markets. So within the fund, we'll still continue monitoring how most of this debt behaves, but we don't honestly believe that we can have a default event for Kenyan debt. On the African continent, again speaking to Eurobonds, so we've seen, we've not actually had a default event other than Ghana. And even in Ghana, the IMF has stepped in to work with the Ghanaian government to actually create a sort of restructure of their Eurobond debt. And we believe that very soon. I mean, we've been receiving a lot of positive updates on what's happening there. So we believe that they will actually find a solution to their debt situation that they found themselves in. And other than Ghana, most other African Eurobonds are still looking very good. The Nigerian ones, the Angolan ones, and we also believe the Kenyan ones. So we still feel that it's an exciting space to take advantage of volatility to squeeze in a return. We can also speak to the issue of recurrent expenditure in the government and how this relates to debt. Like I said, this is mostly due to maturities that were falling due. We believe that the government looks reasonably committed to reducing this recurrent expenditure moving forward. And again, this is a narrative that is pervasive around the world. In fact, as we speak, in the United States, we have the Republicans threatening to create a fixed debt ceiling there, and that might actually lead to a government shutdown. So you can see how these kind of conversations are very difficult, but not unique to our Kenyan environment. But moving forward, of course, we expect that worst case scenario, the Kenyan government has many options to restructure debt. For example, and we've seen this successfully done before, we've seen the Kenyan government switch some bonds for others, thereby increasing duration of their debt. I mean, those are possible options for them. We can see the Kenyan government, for example, issuing a zero coupon bond, so maybe a 3 to 5 year zero coupon bond that reduces near-term cash flow pressures, while still giving investors the kind of yield that they are looking for. So all these are options that are on the table for the Kenyan government, which reduces our concern for Kenyan government risk. So once again, from the team here at SIB, specifically the Mansa-X team, we really want to thank investors for continuing to support us. We've seen a continuous growth of the fund, and this is not just a factor of the returns that the fund is making. It's really also just a factor of the fact that you as investors believe in us, you continue to invest with us. We really appreciate the faith that you have put in us. One of the things I'd advise our clients to do, however, is to also try to hold their funds within the fund much longer. I mean, we do not have liquidity issues within Mansa-X. That's one thing we're very proud of. But continuously interrupting your own investment by pulling out your investment, especially before period ends, especially quarters, that can actually affect your returns, because you might withdraw on a day that markets were particularly fickle, which might then affect your return in the long run. Because we find that investors who stay with us, for significantly longer periods always end up outperforming other investors who withdraw, then top up again, withdraw, and so on. So we'd advise our investors, when they can, to just try and place funds with us for longer than, say, maybe at least 6 months. One of the things we have tried to do within the fund is not create a penalty for withdrawal. And the other thing we try very much is to pay withdrawals very quickly after you make a withdrawal request. So that will continue. But for the sake of your own fund performance, or rather your own investments performance, we recommend a longer holding period to our investors. But moving forward, we still think Mansa-X is one of the best vehicles anyone can invest in. It gives you exposure to so many asset classes that a lot of things would have to go wrong for you to have a dent in your capital. And on top of that, we have a very good risk management framework within the fund that continuously protects our investors from any downside risks to their portfolio. Thank you very much for continuing to invest with us, and wishing you a good Q2. Thank you.